is Rob Barnett. I'd like to welcome you to today's BI Energy Exchange. On the call, we've got Sally Omaz from his usual perch in Dubai, swinging further west. We've got special guest, Dal Martins, who works with Patricio, doing some of our gas and utilities work. So very happy to have him join us. And then swinging across the pond, I'm in Southern Florida here at the moment, and we are likely going to be joined by our colleague Vince Piazza, though he's double booked. He's doing a radio hit before, and once that wraps up, I think he's going to try to join and offer some comments as well. So first and foremost, I want to come to Sally this week. Will Hares, our colleague Hinnock Fund based in Asia, have been doing a marketing trip in that part of the world. I know you had a number of meetings, events, and discussions with clients, and I think it might be interesting to hear what your perspective was on that trip. What kinds of questions and dialogue were you having when you were in Singapore and Kuala Lumpur as well?
Sure, thanks, Rob. Yeah, I mean, it was a very good and very fun trip. We were in Singapore for a couple of days and then in Kuala Lumpur for a couple of days. And generally, I mean, what we shared with our clients was our oil market outlook. I did share a lot of the results from our oil survey just to show kind of where the sentiment is when it comes to the things that matter for the oil markets. There was actually a lot of interest around OPEC, OPEC Plus, what the group might do next. A lot of interest around, I shared the 5 key drivers that we always talk about for oil prices and which ones might be perhaps more important than others. Again, a lot of interest around OPEC policy, but also a lot of interest on Chinese demand. We had our colleague, Henrik Fang, our counterpart in Hong Kong. He joined us in this trip and he shared in a lot more depth than we normally do about what's going on in China. He actually seems to be a little bit less bullish on the demand picture, especially in Asia, and on the general oil outlook than at least I am. But generally a lot of interest on the demand side, what's going on in China, and on the supply side, what's going on with OPEC, what their strategy might look like in the second half of the year. But I mean, one thing I'll say is in terms of demand, what we're hearing recently is, I mean, demand is proving to be pretty strong so far this year, and I think there are a couple of drivers for that. One is actually not China, but the US. The US outlook for consumption seems to be getting better. And on the other side, with the turmoil that we're seeing in the Red Sea and the conflict in the Middle East, because the ships actually have to take the longer routes, that's actually adding to the demand of shipping fuels, which is adding to the overall demand picture. And finally, not China, but actually India. Some of the demand indicators in India are looking pretty strong, at least so far this year. So I think that's adding to the confidence around oil demand growth this year. And what we saw not last year but the week before that with the IEA report, they actually increased their demand expectations for this year, and I think they also quoted the US demand growth and kind of the general US picture looking better as one of the drivers for why they are a little bit more optimistic about demand growth this year.
Okay, very interesting, Sally, and I'm particularly intrigued by the dynamic between India and China, and kind of where the sort of future sources of demand will come from. Maybe this will be a good opportunity to just get your perspective on energy transition, because I think that feeds into particularly kind of how you think about demand over the sort of medium and longer term. And I know there was a big energy event. My former employer, Sierra Week, had their big powwow just a week ago, and I believe the CEO of Saudi Aramco made pretty provocative comments on the energy transition, and I want to get your response on that.
Sure, yeah. I mean, a pretty big conference. Unfortunately, I wasn't there, but a lot of the industry players, a lot of CEOs were there. And yes, I think one of the some of the most striking remarks were from the Aramco CEO. And I think what he said was that the world should abandon the fantasy of phasing out oil and gas. I mean, that's the type of wording that came up a lot, especially during COP28 last year in Dubai. The language around, okay, do we phase out fossil fuels? Do we phase down of fossil fuels? Like, what do we do about fossil fuels? And what Amin Nasser said is that maybe the world should abandon that fantasy of phasing out oil and gas. And he said that the low carbon alternatives and all these new energy sources should be phased in, and they should be phased in only when they are economically feasible. And once again, I mean, on demand, this is something that that he comments on quite often, is that it's not necessarily going to be the developed parts of the world, but more the global south that will continue to drive oil demand higher in at least in the next decade. And he I think re-emphasized that these parts of the world will continue to focus on kind of the energy sources that they can afford, and some of the more expensive new energy solutions are just not very affordable for them at the moment. So, and also another favorite thing that he generally likes to talk about is just the need for reinvestment in oil and gas. I think this is a point that's been made many times before on how, you know, for fossil fuels, there's a certain level of investment that needs to go into that sector just to keep production steady. I mean, if we just stopped investing in oil and gas, we would probably be using 3 to 5% of supply every year. So we need a certain level of investment to keep it steady. And if we believe that oil demand will continue to grow, then we need an even higher level of upstream investment to meet that demand. And I think there's been a lot of arguments on whether globally, I mean, Aramco is investing more, some of the other NOCs are investing more, but globally, are oil and gas companies investing more to meet that growing demand? So I think he had a couple of comments on that as well. But I think the most interesting one that made the headlines was about his comments around the fantasy of phasing out oil and gas.
Okay, very interesting. Yeah, I think this is a good place to bring you on. I think the conversation among European policymakers is 180 from what Saleh just described from Aramco and some of that conversation at Sierra Week. So I know you've got a note just out the other day looking at European gas for the summer. What's going on with demand? What's the price like?
Yeah, sure. So I think it's a very different picture here. Just for context, TTF prices, the benchmark here in Europe, are down 33% year to date. And that really is a reflection of a still subdued demand that's caused by, on one side, mild weather over the winter, which curbed residential consumption. And then on the other side, still a lackluster economic activity, curbing industrial consumption. And that trend should continue, at least for now. We continue to see signs of that weakness. Whether in the long term, what the long-term outlook for industrial demand in Europe, I think, is quite uncertain, and that should weigh on price sentiment for now. We're just about to finish winter. On 26th of March, yesterday, gas storage was 59% full in Europe. That's a record high, even higher than last year. And what obviously that has to do with the demand trends I just described. What that means for summer is we'll have to reinject about 45 BCM into storage. That's 4% less than what we did last year. When you look at our supply picture, the LNG market seems to be slightly looser than last year, given the European demand trends. In Asia, we're still seeing a lackluster Chinese recovery, and so that means that there's a bit more headroom to meet our needs. On the other side, Norway last year had significant outages during the summer. That should not repeat this year, and so we have a bit more upside on supply side from there. And what that paints is that we have really good visibility to enter October, if not November, with storage pretty much full, and that will give us another good headroom for winter. And that's really putting pressure on prices, and we think that should continue over the summer and perhaps into winter as well.
I want to gauge you a little bit more on the demand trajectory. I always get the sense that following Russia's invasion of Ukraine, that particularly on the industrial side of the equation, we've really seen a retreat, and we haven't seen a bounce back in demand from my understanding. And so I'm curious as to how European policymakers, market participants are approaching that. Are they looking at this lower gas price that you described and sort of saying, great, the market's a bit more balanced, we can consume more? Or are they saying, hey, it's the price is down, but it doesn't really matter, we need to continue to curb use?
I think it's a bit contradictory here in Europe in the long term versus the short and mid term, where in the short term we're still trying to find signs of higher gas demand because that will show signs of recovery in industrial output. But in the long term, I think policymakers remain really committed to renewables, really committed to the energy transition, and there's not really a lot of support and signs that they want to see much higher gas demand. Whether that will happen or not, I think is quite uncertain. But definitely on the European side of things, we see a lot more willingness to expand renewable energy, to expand new sources of fuels, rather than a focus on gas demand. So I think that perhaps poses a problem for companies and for our utilities when they think about, okay, in the near term, we need to build supply security, and they had to build a lot of regas capacity. But then in the longer term, the demand profile is quite uncertain. So when they're making these large investments, the long-term profile of those investments is quite uncertain. So I think it poses a risk to the sector and other players involved. But whether demand will ever rebound to where it was, it's probably unlikely. But it still should recover partially from where it is now.
Okay, fantastic. Thanks for that perspective. Looks like we're still waiting on Vince to join us. So, Sally, let's come back to you. And I'm very curious to continue the discussion on demand, not just for gas, but for oil. And I think IEA's got a new estimate out, and we got a pretty bearish demand outlook there from out of Europe. But what's the, I mean, you already kind of highlighted that there's potential demand growth even out of the U.S. and India and other places, but where are the chips falling on the trajectory of global oil and gas demand at the moment?
Yeah, so I mean, when we look a little bit more closely on the table of demand expectations that's broken down into regions by the IEA, I mean, it's not really OECD countries that will be driving the demand growth, as it has been the case for a while now. When we look at this year, there's a slight increase expected in the Middle East. Further recovery expected still from China. I mean, that's a very uncertain outlook as well. I mean, that's one that a lot of analysts got wrong last year in terms of how much marginal demand growth will be from China, but also from the rest of Asia. IEA is still expecting more demand growth. But I think what's interesting here is that, just to give you context on how we really don't know what the final number will be. So the range of demand growth expectations are between now IEA expecting about 1.3 million barrels per day of demand growth this year, and then OPEC is still expecting more than 2 million barrels per day of marginal growth. I think around 2.2 million barrels per day. Again, I mean, these are always subject to revision. Usually IEA tends to be a little bit on the conservative side and revise those numbers up, but we really don't know how some of these big drivers like China will shape up as the year goes by. But yeah, like I said, I think one of the more surprising ones and perhaps the unexpected ones, as I mentioned earlier, is shipping fuels. I mean, I don't think we were expecting more shipping fuel consumption this year, but because of the conflict in the Middle East and because of the diversions that we're seeing for the vessels that are trying to avoid the Red Sea and the Suez Canal and essentially going around Africa, which is obviously increasing the journey times, which means they end up using a lot more shipping fuel. So that's what they're expecting on the demand side. And I mean, I should mention very briefly on the supply side, one other interesting point from the latest monthly IEA report was that they are now expecting a deficit in the oil market through this year, and that's a shift from what they were expecting the month before. And I think it's partly because demand is now expected to be a little higher, but I think they're now assuming that OPEC Plus will continue its current voluntary output cuts all the way through this year, which is in line with our core scenario. I mean, what we know so far is that OPEC Plus has extended their output cuts into the second quarter. The next big decision for them will be when they meet in Vienna in person on the 1st of June. And that will be the time when they decide on what to do in the second half of the year. That will be the next big decision for them. But it looks like, I mean, there's still a lot of time between now and June, but our expectations are that these cuts will probably be extended into the second half of the year, because when you look at the physical markets right now, I mean, they are looking rather tight. When we look at the oil curve, it is still in backwardation, and I think this is exactly where the group, where OPEC Plus wants the market to be. So IEA expects the market to be in a deficit all of this year, and that's not too far from our core scenario for the supply-demand balance for this year.
Thank you, Sally, for that. This may be more of a question for Vince if he's able to join us, but kind of hearing you talking about shipping around made me curious. Obviously, if you've seen the news in the U.S., there's the Scott Key Bridge in Baltimore was damaged, or I don't even know if damage is the right word, destroyed after a ship collided with it. And my understanding is that port does play a role in some of the refined product markets here in the U.S. Have you noticed any change in the oil market or refined product markets as a result of that, or is that much more of a U.S. story there, Sally?
I haven't, but I must say that I haven't looked in perhaps in as much detail as Vince might have. But it looks like it was more of, perhaps for coal, it was a bigger deal. I think for autos and autos parts, I think it was a big deal. For industrials, it looks like it was a big deal. But when it comes to crude and products trade, I don't think it moved the needle from what I saw. But again, I mean, I'm looking at the European products a lot more closely than the US one. So I may have missed it, but from what hit the wire on my screens, I haven't seen, I think there is, there is a, on the chat, someone is saying impact on bulk ethanol imports for gasoline, regional and coal exports. So that sounds about right. Thank you to Ken, who commented that on the chat box.
Yeah, thank you. Feel free to pop in questions into the chat. We do monitor it, and we try to get to some of those kinds of comments and our questions as we're going through some of the material. that our team has put out over the past couple of weeks. Yeah, I want to come back around to you, kind of shift gears a little bit, and talk more company specific. I believe there have been some renewable focused M&A unfolding that you and Patricio have been looking into. And so I want to get a sense from you. And we've had a lot of discussion on the traditional fuel markets here so far. What's going on the renewable side of the equation, particularly as it pertains to some of the European names you cover?
Yeah, sure. And I think that ties well into your previous question about the energy transition. So recently, the American private equity fund KKR proposed to acquire Encavis. Encavis is a renewable developer from Germany. They hold about 3 gigawatts of installed and under construction capacity, so not a huge player. They're largely diversified in Europe and biased towards solar. And what's interesting is that the deal implies a more than a 50% share price premium versus the previous close, almost 30% enterprise value premium. So um, really high values. But it's important to look at that on the context of the sector. The peer groups that we cover and some of the larger names include Ørsted, EDPR, Acciona as well. The peer group is the share price on average is down about 35% over the last year. And that really has to do with a couple drivers. Number one, higher interest rate expectations for longer. That directly affects the valuation of some of the assets that they manage. And then second, something that we started seeing since summer is a rapid deterioration of the power price outlook across Europe, particularly in Southern Europe, and that obviously impacts the earnings outlook of these companies. So that drove a deteriorating sentiment for the peer group. Now, what this deal did was to bring Encavis's valuation back to its historical norm, back to where it traded in January 2023, and kind of implying a stronger confidence in the longer term outlook of the peer group. And that ties to some of the research that we've been doing, where we're pointing towards potential upside for the earnings outlook from 2H particularly. That's due to number one, a potential easing of interest rates. Second, there's mounting signs, I would say, that policymakers will increase their support for renewables. Last year, a lot of the story was about the projects that were auctioning for PPAs and CFDs not getting the prices that they needed. And there's been recent signs. Ørsted got a couple new positive auctions for them in the US. The UK already hinted at higher CFD prices. So there are signs that the policymakers will help these renewable developers achieve the returns that they need to continue build, because all of these governments and states in the US, they are still committed to their climate goals. And that means that they need to either put up the money or accept reduced goals. I think we're in that situation. So we do see some support for the peer group. We think this deal proves that, and it is aligned to transactions that we've seen in the private market for renewable assets, not for companies, but for assets that still fetch the same multiples that they did 2 or 3 years ago. And so we believe there's still some confidence in the outlook of the group.
But curious, have you noticed any traditional companies taking a look under the hood at some of the renewable players? So, and there was a trend for a while where I think the projects that you mentioned for Ørsted, where you have perhaps you know a major international oil company either partnering on some of those projects or maybe even looking to own assets in the space. I think you said it was KKR in this instance, but what's your sense on the appetite or interest from some of the traditional energy companies looking into these renewable plays?
Yeah, so I think on the utility space, utilities are coming from a period of really high leverage and elevated borrowing costs. So the focus really has been over the last year and a half on reducing their balance sheets, on reducing their borrowing costs. And there haven't been large M&A deals other than perhaps RW, which acquired Con Edison in the US. But there haven't been M&A between utilities has actually decreased significantly over the last year. What we've been seeing more recently, and KKR is a good example of it, is more interest from private equity funds, from other type of funds in buying assets, in buying smaller developers. And KKR has done, I think, over the last 3 or 4 months, they've acquired 3 or 4 renewable linked companies in Europe. So there are signs that this type of player are interested in perhaps fetching these companies that have a stronger long-term outlook that is highly contracted for perhaps an opportunistic valuation. I think we might have lost Rob.
Yeah, we can't hear you, Rob, if you're still there. Hey, Rob, can you hear us? Yeah, I think we may have, yes, sorry, Rob, we can't hear you. But anyway, Vince has just joined us, so it would be great to kind of get some of his thoughts on what's on his mind. If you've published anything, I haven't really, I don't really know what Rob was going to ask you, but
well, I think what's interesting as we head into the close of Q1 is what that 2024 outlook is going to look like coming off of the 4Q earnings, and as we get into 1Q relatively soon. Look, the backdrop is steady as she goes on the oil side. OPEC is driving this boat, Saleh, as you know. We're not looking for a great deal of production growth coming from the domestic U.S. guys. What we are going to see is much more discipline in 2024, similar to what we saw in 2023. Growth overall, single digits. The operators that have been bought from 2023, that where you saw significant growth to pretty themselves up for the M&A market. We're seeing that growth level off and actually turn down. We haven't really seen the recovery in rigs or in completion crews. So we're really not thinking about production growth. What we are thinking about is what are they going to do with the free cash flow? And you know, I still think we're in this consolidation phase, this maturity phase for the U.S. operators. Having said that, on the natural gas side, we still seem to be suffering from a really warm weather, and that has elevated the storage surplus heading into what is typically the injection season lull here in the springtime. But sub $2 gas, sub $2 natural gas isn't sustainable. And we think the discipline that we're seeing from Chesapeake, CNX, EQT, I think that'll stick. And these are important operators. These are important producers. They're top 5 operators in the U.S. in 2 key basins, Marcellus and the Haynesville. So seeing that discipline will turn the market hopefully in 2H as we see some of the benefits of that output being curtailed come to fruition. We've had periods in March where we were sub 100 BCF a day on production. Part of that is curtailments. Part of that is, you know, natural decline as well. But we need to see that discipline because we didn't see the demand side. We did not see the demand side in the power stack. We didn't see it sustainable over the course of the key seasons in January and February. We were wrong about winter. We got as high as 330. We were looking for somewhere in the 4s. So, you know, we were fortunate these last few seasons to get it right, but you know, everyone has to reassess their models in times like these. So we'll look to regroup for the summertime and also next winter as well. But for the most part, steady as she goes on the oil side. But you tell me what OPEC is going to do, and I'll tell you what my Permian-based operators are going to do. We need to do a lot more work on the natural gas side.
Cool. That's great. Thank you, Vince. We talked about OPEC briefly earlier on the call. Rob, are you back? Was there anything you wanted to ask Vince?
I was just going to say, if you can hear me, do a quick round robin on, we're a few days from 1Q officially ending, and, it won't be too long before we enter the reporting season for that. So maybe it'd be great to just get a quick pulse of what you think we're going to hear when we get to 1Q results. And so we'll just quickly run around. Vince, will come to you first.
Yeah, so I think you're going to see more nat gas curtailment just because of where prices are, and that'll help us reset in 2H. In terms of the oil side, my Permian guys, steady as she goes, integration of the acquisitions, and we'll likely hear some more about 2024 consolidation. I still think there's more to go on that. There are smaller operators that need to make decisions because I don't think the funding will be there, and I think you will still have this trend of bigger operators but fewer operators in the Permian, and that'll continue as well.
Okay, Sally, over to you.
Yeah, I'll try to keep it brief. I mean, more of the same, really. I think, the benchmark oil prices for the companies that we cover are holding up pretty well. I mean, we've broken out of the $80 to $85 a barrel trading range recently for Brent. So upstream is looking still pretty healthy for these companies in Europe and the Middle East. And on the downstream side, I mean, refining margins have been very, very resilient, and they seem to be getting a lot more support now from the turmoil in the Red Sea. Further supply squeeze because of that turmoil. Increasing freight costs are actually adding to the fuel prices as well. So it's we were expecting normalization, especially in downstream this year. I don't think we're going to be getting that just yet. The first half of the year is looking rather solid for these players. So just more of the same, more of what we saw last year, at least for another quarter this year. And we may have lost Rob again, so I'll just go over to Joao on what he's expecting from his companies in the first quarter.
Yeah, so really quick, just two ideas. First, the continuation of what we saw last year with companies really focused on continuing to limit their leverage and curb their borrowing costs, which have risen rapidly. That's a key trend in our sector. And then the second one is we'll start seeing more effects of the lower power prices on the earnings of our utilities here in Europe. So that's going to be something to watch for in Q1.
Fantastic. Well, if you guys can still hear me, I'm not sure if you can, but if you can, the only thing I would say to close out is that, Sally was in Singapore and Kuala Lumpur last week. Next week, Vince and I and a bunch of our colleagues are going to be in Kansas City. So come see us. We're not just faces on a screen. We are regularly holding in-person events these days, and we hope you can join us for one of these. And the agenda is pretty great on the Kansas City event. Lots of external speakers, so you don't have to just hear from us. You can hear other voices from the market. So if you need any details on that event or any other upcoming events, just ping any one of us. We look forward to being in touch. I hope you have a great rest of your week. Take care, everyone.
Thanks again. Be well.